Hello everyone, good late afternoon. Thank you for staying with us and not jumping on the plane or going to work tomorrow. This talk is about decentralized finance by Tomas Marada. And what is really interesting about Tomas is that he's a mathematician, so he has a very interesting way of looking at the cryptosphere and derivatives. What I learned from Tomas while working with him on some projects is that these derivatives, they can be really nice building blocks, and you can use one derivative to build the others and so on. So it's very nice if you like to play with Lego. It's kind of the same approach. You can take pieces and put them together and build something else. So this is one of the things that Tomas will talk about. I also like that he's talking about it on Bitcoin, because a lot of decentralized finance is on top of other projects, other coins. So please welcome Tomas Marada.
Thank you. I will try to, on the website, I announced that I will talk about loan and if it's possible to build a trustless loan on top of Bitcoin. Yesterday evening, after many discussions here, I changed the topic of the talk, make it a little bit more general on decentralized finance, but the loan will be included, so don't worry. First, I would like to talk about why financial products such as derivatives and decentralized finance are good for Bitcoin. Because I see many people in the community, they tend to think about derivatives as something which is toxic and not very good for Bitcoin. And I would like to change that, because good derivatives are good, as good money are good, and bad derivatives are bad, but they shouldn't be thrown in one basket. Money and debt, they are almost inseparated. Classical economy think about that money came up from need to barter. Anthropologists, on the other way, especially this in this book from David Graeber, who is behind Occupy Wall Street, argues that barter was probably not the way how people before money interacted between each other, but they much more likely had debts against each other. And he argues that money was a construct how to have some unit of account in which you can subtract debts against each other. So I highly recommend this book. And as soon as you have debt and money and market, you have some risks. You have risks that the price will go up or down, interest will go up and down, and you have natural need to hedge this risk. And as people and the economy in old age grew, they came up with different ways how to hedge against these risks. And they came up with derivatives. Derivative has primary need as an insurance against some risk, and secondary use as a trading instrument. And many times people think about derivatives only in trading context, but without the primary need, there would be no derivatives at all. And I believe that with Bitcoin we have similar needs, and market participants in Bitcoin and companies in Bitcoin have same needs, and they need to hedge out risks, and they need to, if they have ways how to hedge it out. They can plan more reliably their business cash flow and so on. And traders, which sometimes are thought of as parasites, I think they bring liquidity, and the good liquidity is essential for the primary needs of derivatives, because then if someone wants to insure, he has a cheaper way how to do it. Where there is no liquidity, this insurance is much more expensive. How many of you know what is it future and how it works? Okay, most of you, super. Just very quickly, it's an agreement between two parties which seek to get an exposure to the asset without actually buying the asset, and they open position at a nominal value. Here in this example, it's $10,000. And they don't need to have $10,000. They just need to put somewhere a margin which covers, which has to cover the intermediate price action. And on the same side, and similar on the other side, short part of the future. Derivatives are great, or the more different derivatives, the more instruments how you can trade the asset or gain exposure, it leads to more efficient price discovery. If you have only a spot market, you have opinion that Bitcoin is undervalued, you can express it only in one way, that you go long. You buy the spot and maybe sell it later as soon as you get to the price where you think it's on spot or overvalued. But as soon as you have many different derivatives, you can build different exposures. And for example, in this one, you think that the price will be somewhere around B and C, and you are here in profit, here you are losing. Similar here and here. And the more traders can express their opinions, it leads to more efficient price discovery. So Bitcoin financialization leads to more efficient markets. Currently, financialization of Bitcoin is already well in progress, with the traction especially in centralized solutions. And if you want to trade the asset, you need to have an exchange. You need to have a way how to swap between Bitcoin and fiat dollars. You have to have lending, where you can borrow either fiat or Bitcoin. Bitcoin mainly for shorting, and with more developed market, you find a need for derivatives as well. Right now, most of exchanges is derivative exchanges are unregulated. CME, which is regulated, has very low volumes, but they are growing, and I think that in the last few months they get over the spot markets in traded volume. What we see on Ethereum? Ethereum is well, there are not much dApps which have any traction, and the traction dApps with some traction right now are mainly in DeFi, decentralized finance, because with centralized solution you usually have counterparty risk. You are giving up privacy with KYC procedures, and decentralized solutions right now are being built mostly only on Ethereum. So first you need to hold dollars somehow. So they came up with stablecoins. Most of them are centralized. Probably the only exception is DAI from MakerDAO, which is decentralized, and it's backed by Ether, but they seek how to extend it to other assets, especially to Bitcoin. Recently, there are two stablecoins which tries to port Bitcoin value to Ethereum and allow Bitcoin value in DeFi projects on Ethereum. You have exchanges such as Binance decentralized exchange, Uniswap. Uniswap is really simple smart contract. They all have Bitcoin stablecoins, Uniswap and Binance DEX, but they are built on Ethereum smart contracts, and many hodlers do not want to take their Bitcoin, the majority of their Bitcoin or big part of their Bitcoins, and risk it on Ethereum or even centralized stablecoins, Bitcoin stablecoins on Ethereum. So next to in lending, MakerDAO is a smart contract where you can lock Ether. Right now Ether, later they seek to add Bitcoin and other real world assets as well, and create stablecoin DAI. It has I believe about slightly less than $100 million value locked in. Compound has great traction. It has about 150 million value locked in and growing. The disadvantage of these lending solutions is that you have to put in collateral with much higher value than is your loan. And so if you want to take 1 million, well, 1 million, $10,000 loan, you have to lock probably at least 30,000 value of here Ether, or Compound allows the Bitcoin stablecoin as well. And there are some smart contracts which tries to allow derivatives as well. And I will try on next slides explain how this is completely unnecessary and we can build it all on top of Bitcoin without need for smart contracts. We need just one important thing, and that is future. By combination of spot Bitcoin and future, we can replicate all these things on the previous slide. First, if we want to have a stablecoin on top of Bitcoin, we just need to combine one here. I have one Bitcoin, which is I can have it on a margin on exchange or in my wallet, and I open a short position in future, and the combination of the short position in future and holding of one Bitcoin will always lead to value $10,000 regardless of price of Bitcoin. The Bitcoin can go up or down. I still have 10,000. If Bitcoin goes up, my Bitcoin is appreciating, but I'm losing on the short, and vice versa. So this is way how to hold dollar value and potentially any other asset on top of Bitcoin. If I want to exchange it to Bitcoin, get out, I just close the position. That's very helpful for anyone who accepts Bitcoins and doesn't want to be exposed to the volatility. such miners, ATM providers, e-commerce accepting bitcoins, or traders. Though it's well, yeah, traders. Now I'm getting to the loan, which I promised. I 2 years ago I started thinking about my own need and other my friends hodlers, that they have gone all in to Bitcoin. They believe in appreciation to future, but don't have any other big source of income, and they want to finance some consumption or would like to invest more money, more capital in Bitcoin, but don't have any. And the only way how to do it right now, or not only, but the main, is to take a loan. Let's say I assume an example where I have one Bitcoin at $10,000 and I need to buy $1,000 TV. I can either sell 1/10 of Bitcoin and be left with 0.9, or I borrow $1,000 for in collateralized loan, and I'm left with one Bitcoin minus debt of $1,000. It's same net wealth. My net wealth is $9,000, but my dynamics with which it will change is different in both cases. I can replicate this loan using future, because the need that I don't want to sell my Bitcoins is that I want to keep exposure. I want to keep the exposure to whole Bitcoin, not just 0.9. So it's very simply can be replicated by actually spending that 0.1 Bitcoin and opening a long position in future at $100,000. In this way, I kept exposure to whole Bitcoin, though I have only net wealth $9,000. And actually, here, if someone has a short position, here I am. That's my one Bitcoin. I opened. Well, I spent 1/10 of it. I opened long position in future. Here is my counterparty, and the counterparty is having complete position with their 0.1 BTC. So they basically locked $1,000, as I explained before. And using these futures, they are borrowing me or lending me the liquidity. So this guy who is short and long Bitcoin and short future is borrowing me $1,000. Here should have been a table. Myslím, že to můžu nějak posunout. Tady není ta tabulka vidět. Ona měla být. Asi jo. Mhm. Super. Jo, super. Here I have three different strategies. What I can do if I start with one Bitcoin at $10,000 and I want to buy a TV for $1,000. I can either spend 1/10 and I will be left with $9,000 net wealth, or I can borrow with some centralized solution, or I can spend 1/10 of Bitcoin and open long position in futures. In all strategies, I have same outcome. If Bitcoin goes to $20,000, here my net wealth doubled to $18,000. In these two strategies, I have $19,000 because I didn't spend my Bitcoin, or here I did, but I compensated for it by opening long position. Here it's 20,000 minus $1,000 debt, and here it's 18,000 plus 1,000 profit from the long position. In last column, there is a situation with Bitcoin going down to 5,000, where I would be best if I spend my Bitcoin and didn't take a loan, because if I'm taking a loan, I'm basically leveraging myself a little bit, and both ways I'm getting more. I'm gaining more profit if Bitcoin goes down, and I'm losing more if Bitcoin goes down. Bitcoin, not Bitcoin, but futures in general tend to trade at a little bit different price than spot. If there is a lot of people who want to go long, they have to pay something extra to be able to go long to short side. So in a bull market, the future price tends to be above the spot market, and in bear market, when there is more sellers, the future price tend to be below, and that is implicitly an interest rate in these replication strategies. So anywhere where I mentioned that you go long in bull market, you will have to pay for it, some interest rate covered in this market dynamics. If you get short, you are paid. So in this stablecoin setup, where you buy spot and open short position, you have very well funded interest rate. In last bull market, you could get about 30% interest rate. VA. The difference between these two approaches, either normal loan and future replication by future, is mainly in capital efficiency, because in loan you have to put down collateral which is manifold higher than the nominal value of the loan, and in future you have to put just margin which might be about 20 to 40%. So your capital at risk with counterparty is much smaller. You can open bigger positions, but you might trigger capital gains. That's the disadvantage, because loan is a tax neutral thing. With future, you might get capital gains. So with DeFi, I'm arguing that all these DeFi can be built on BTC only with correct combination of spot. Stable coins, combination of spot and short position in future. If you want to exchange, get from dollars to Bitcoin, you just close the position or open the position. Lending, it's spot and long position. And if you want to trade, you can just go for it. The only disadvantage of this is the exchange itself. If you go for current exchanges, you have to go either to regulated exchanges where I don't expect so much counterparty risk, but I'm risking my privacy, or to go to unregulated exchanges where I'm exposed to counterparty risk. The exchange can be hacked, it's not insured. If it goes bust, I will not get anything. So I think we should build a decentralized future, because out of this future we can build many different products on top of it. And a simple future as a peer-to-peer contract might be only a contract between two people. The simplest possible is just between two friends who trust each other, and they decide that one has, for example, dollar liquidity and seeks some interest, some profit, and the other one wants to bet on the coming bull market. So they agree that they open a future position between each other. One goes short future and buy the spot. So if the nominal value is $10,000, this guy will buy one Bitcoin for $10,000 and open short position. The other guy will just agree that he will take long position and pays for it an interest rate. I think that 15 to 20% is completely reasonable. And they regularly settle in a way that the first guy who wants the interest rate has always $10,000 plus the interest rate. If Bitcoin goes up, his Bitcoins, which he bought in the beginning at a spot, are slowly moving to the counterparty. If Bitcoin goes down, it goes the other direction. If they don't trust each other, they might get down some margin into multisig, 2 of 3 with an arbiter, which they choose and they trust. And in case of dispute, this arbiter can resolve them. And I'm working together with few people here on a concept how to build a decentralized future with a network effect on top of on-chain and Lightning, and with shared liquidity. And if you are interested, definitely stay for next talk of Patrick Tekorda, who will talk about this. And that's probably all from me.
Okay. Thank you very much. Do we have questions from the audience? So maybe I will share my experience. How I realized that I can use these Bitcoin futures. I realized that I can actually do what Tomas said with having a dollar balance on my bank account exactly by this strategy. So if you have, I don't know, $1,000, you can, and you don't want to be exposed, you want to keep it in dollars, you don't want to be exposed to crazy price movements because you've had enough and so on. You just want to keep your $1,000, you can put it in the bank and pay fees and negative interest rates or zero interest rates to the bank. So it wouldn't do anything. It's just, you know, you give someone your money and it sits there. And I realized as a Bitcoin person that what I can do is I can take these $1,000, buy Bitcoin worth of $1,000. So I get the spot position in Bitcoin, and then I go to BitMEX and I short $1,000 on a Bitcoin future. I still have $1,000. It's in Bitcoin, and I get paid an interest rate which is positive. So this is one of the use cases. And the only problem with this approach is what if BitMEX gets hacked, or what if something happens to my money. But for me, just realizing that I can do this means that I can have a much better bank account, because I still keep my $1,000. I don't need to worry about exchange rates and wake up every morning and see if it's red or green. I can have the stability and get paid some money in order to do this. So this came out of discussions with Tomas and Patrick, and it's a really useful thing, because when you talk to people about Bitcoin, they say, "Oh, I don't have the stomach for the volatility, therefore I cannot use it." And it's not true, but you need to kind of dig a little bit deeper and look for solutions. So, okay, now an actual question.
Thanks, and thanks for the presentation, actually. Um, Cannot we use this over here in Paranapolis for pricing the goods which are there on the table? Like, you want to buy some things and it's nominated as 150 Czech crowns. Why it is nominated 150 Czech crowns? Why it is not nominated in Satoshis? Can we use it? Well, I asked there and the answer was, oh, because of the volatility. Because of the Bitcoin volatility. So we could use this actually to...
They could use to hedge it out if they accept the Bitcoin to hedge it into Czech crowns or dollars, but they would have to change the amount of Bitcoins paid for it like every day almost. Yeah.
Hello, thanks for the talk. Can you provide a little bit more of technical details? How do you see it implemented, especially in decentralized fashion? Because you have mentioned that we can, Alice and Bob can go 2 or 3 multi-sig with an arbiter, but then I guess arbiter becomes the central point of failure. And yeah, in a situation like MakerDAO, you would need price oracles, etc., etc. Thanks.
I could elaborate on that, but I would recommend the talk of Patrick, because it will be about that.
Okay, okay, thank you. Do you have a GitHub or something that I can follow on this development?
GitHub, we're in a conceptual phase. We want to publish extended white paper soon and push rather the movement. We don't want to build it only ourselves. Would be helpful if there would be more companies trying to build it. Okay.
But there's a description on how to do it on top of Lightning Network as well, not only multisig. So there's a paper that, yeah, so there's a paper, but Patrick will talk about it. But what I really like is like the low-tech version, which we used in Paralpolis in Bratislava, of collateralized loan, which you can really do with people physically. So you say, okay, please lend me 1,000 euros. Here's the collateral, and we can make really a low-tech paper contract and do it within the community. So like the step 0 is actually not to write any software, but to really do it in the community, and that works. And we have tried it, and it's a very, very useful way how to finance stuff. And these steps are kind of technological evolution that will create a more liquid market, I guess.
Hi. Thanks. I'm very excited personally about the project. I've and the possibilities of how to sort of spread it, spread this type of new financing. But so far we have examples with 1,000 euros, for example. It's great for on an interpersonal basis. But I'm wondering if you guys have some more information, perhaps in the subsequent talk, that we could address how this can be scaled up, perhaps on a more larger B2B scale, where perhaps we can integrate the participation of miners, for example, who are natural clients for this product, and other, large-scale, Bitcoin-centric people and corporation or cooperatives, and perhaps also link this up in terms of how to hedge sequestered coins or kind of under your structure, how to link them with perhaps existing exchanges, even, you mentioned Deribit or others, to smooth out the hedging requirements within those. Just something to consider. Thank you.
Thank you. About scaling, Patrick will definitely talk about netting out the positions and collateral needed for the positions. We don't have the solution for that. Not yet.
Next steps then, I guess.
Yeah.
Because on the big scale, we're talking 1,000 Bitcoins, for example. Those are the exposures we might want to look at hedging or working with.
I understand the need. Would be very helpful. It's far in future.
Hi, thank you for your talk. I have a question about the interest rate on Bitcoin. How is this, what is the fair interest rate, let's say in Bitcoin? And since the future price, I guess, is really sensitive to interest rates, do you believe that there will be a lot of arbitrages opportunity in this market? I mean, how efficient can be the future the future markets with not stable interest rates? So the first question is, how do you calculate the interest rate? What is the fair interest rate for BTC, for Bitcoin? Because I mean we use the so-called risk-free interest rate in future contract for stocks, but there's no free.
Yeah.
Thank you.
I would question if there is even risk interest rate in traditional finance, but yeah. Here I wanted to show how futures market and basically trading is interconnected with lending, that it can be replicated with each other. So the premium on future derivatives is very closely connected with interest rates in lending. They influence each other very heavily. So if the market is very bullish and seeking for any dollars he can lend to buy more Bitcoin, the interest rates will go up and vice versa.
Thank you. If I may just follow up on that point, so I think it's very, very valid. I've observed, I haven't been a personal user yet, but you noted services like BlockFi and Nexo. And my understanding from what I've heard is that they pay a stable interest rate in return for coins that you lock up, which equates to approximately 6% per annum on average. So I don't know if maybe we might want to look at that as a starting point and then see how that balances out with other market rates or services. And actually, I have a question on that, if anybody knows the answers, how those companies, BlockFi, operate there, how they actually serve to guarantee that sort of rate. I don't know, but something to look into. Thanks, guys.
Well, I know that they lock the interest rate for a month. You cannot lock it for longer than 1 month, though they don't change it regularly. And they borrow the assets to counterparties which they personally believe for shorting and trading, and for capital requirements for operation, like for exchanges and so on.
Are there any other questions? Okay, so
if there is no other question, I have one more thing. It's a work in progress, but I would like to share it with you. Well, I believe that we are before another bull market, and I would like to bet on it, but I'm not a trader. And I don't want to time market and be stressed about. I like simple things like dollar cost averaging strategy, which is I think the best possible strategy how to buy in bitcoins. So you buy weekly or monthly some regular amount, and you don't care about what price is doing. I was thinking if this sort of simple, dumb strategy can be ported to futures and profit on coming bull market. So basically, just betting that there is bull market coming, it will play out in next 2 years, and I don't want to time the market, but I want to profit from it. And so I went from the dollar cost averaging strategy. I started, and I backtested it on last bull market, which doesn't mean anything, but it's indication, nothing more. And I'm working on some analysis of it. I start 6 months before halving, and I set some given percentage of my capital, which I every week open or add to my position in futures, and I keep doing it regardless of what is going on. If my capital is going up, I keep increasing. There are few more nuances, but I'm not timing the market. I'm just regularly adding. If I did it in last bull market, and I decided to add 1% weekly, which means that even if nothing happened for 2 years, I would only build leverage 2. I would end up, and I started 6 months before halving and quit 18 months after halving, which was 1 month after the top. I'm not trying to get the top. I was in the calculations getting out at $12,000. If I took 1%, I would end up with 2.2 fold more bitcoins than I started with. And at any point, my leverage was below 1.5. The highest possible weekly increase would be 15%, where I would get to at one point after one big correction, I would get to leverage 14, which is probably way too risky, but I still wouldn't get liquidated, and I would end up with 274 times more bitcoins than I started with. If anyone is interested, write me an email, and as soon as I will or we will get more results, we want to publish it and release it. That's it.
Okay, thank you very much.